The turn of the calendar is just days away. It's time to rebalance your portfolio. Stocks had a fantastic performance in 2025, so that might mean that you're buying some bond ETFs to keep your asset allocation in check. But watch out, you could make some costly mistakes when you do. That's why we've got this bond maven standing by. He's here with 5 tips to help you cut down on the unforced errors. You're watching Inside Investing. Hello everyone, welcome to another edition of Inside Investing, the show that helps you level up your financial knowledge and sharpen your investing skills. Presented by TD Direct Investing, named Canada's best online brokerage by the Globe and Mail for 3 straight years and counting. I'm your host, Rob Moise. And I won't fault you for needing a little bit of a brush up on bond ETFs. They were out of sight and out of mind for many investors with interest rates so low for so long until recently. But bonds are back, baby. So let's find out how to select and trade them with a little more savvy. Joining us is Trevor Cummings, Vice President and Director and Lead of ETF Distribution at TD Asset Management. Trevor, it's great to have you back on the program with us. Thanks for joining us, and in person this time. Yeah,
good to be back. This is my first time in the new format, so it's a whole thing now.
I know. We got a fancy new set, all the shindigs in here going on. It's fantastic. Appreciate you joining us too. It's a very timely conversation that we're having here with rebalancing on the horizon, like I mentioned in the intro. It's sometimes psychologically difficult for people to rebalance, especially in a year like we saw in 2025. Despite some early volatility, stocks had a banger year, and it's tough to go from selling your winners and then buying something, let's be real, boring like bonds. So how can they sort of get over that psychological hump in your mind?
I think maybe there's 2 or 3 things to think about in that regard. Number one is rebalancing is always supposed to hurt, right? There's always going to be a selling a winner to buy something that's lagged necessarily, but that's part of controlling risk in portfolios, number one. Number 2, I would say, is like we did have a really good 23 and 24 and 25. It doesn't mean necessarily that 26 cannot be a good year, but at the same time, if you haven't rebalanced in a little while, you probably are overweight equities and underweight fixed income like bonds. I think maybe the other thing I would add is just, if you think about, say, the analogy of a street vendor. Street vendor has sunglasses and umbrellas on the table to sell you. Now, they're never going to sell you both of those, but they're diversified. They want to have something to market, and that, I think, is sort of maps over to investing at TD Direct Investing. You want to have a little bit of everything so that you're not all in on one asset class or another.
Yeah, I think it's easy, especially with how strong the equity market returns have been, to your point, to get lulled in by this idea that it's okay to be deviating from my plan a little bit, but fixed income can be an important part of keeping you on track. So maybe just give us a quick refresher. Bonds, fixed income in general, like what is it there for? What does it bring to a portfolio?
Yeah, I think, so stock investing, if we contrast it, it's kind of 3 sources of return, right? It's like, is the company making more earnings? What is the market valuing? Is there multiple expansion on those earnings? And is there any kind of dividend? And bonds are very, very different, more moving parts, I think I would say. You have to think about what is the rate of interest on that bond in the context of everything else that's available at that time in the marketplace. You have to think about whether or not that business is getting stronger financially or fundamentally or weaker, and whether that's going to have an effect on your return. You have to think about liquidity and duration. Generally, investors, the longer they lend money on a bond, the higher the return they're going to demand, rationally speaking. And so you've got all these other things, and you've also got interest rates. So you've got outside parties, central banks like the Bank of Canada, moving interest rates up and down to stimulate or moderate the economy, and that has a huge effects on fixed income as well. So it's a bit different of a data set that you have to analyze and consider. I think the good news is that ETFs solve for a lot of that, because with one trade or a few trades, you can get a diversification. Bonds don't trade on an exchange. We don't have the ability to do limit orders or to monitor things or put a bond on a watch list. But now that there are bond ETFs, you can do a lot of that, which I think is an improvement to fixed income investing.
Yeah, and to your point about diversification, bonds, fixed income in general, it's that volatility tamer to some extent in a portfolio. It's not the same as equity, and I think that's something that people need to keep top of mind as well too. In any case, bond ETFs, They're a popular product amongst a lot of investors. So let's get into some of these tips that you have to help avoid some of the common mistakes that people run into. And for those in our audience, if you have questions for Trevor that you want him to answer, we're going to get to as many as we can later on in the show. So make sure you send them in to us. On Webworker, you can use the questions box. On our broadcast platform, you can use the questions and comments box. And on our YouTube live stream, you can follow the link in the description. It's going to take you over to our broadcast platform, and that's where you can ask your question. Okay, Trevor, so the first bond ETF mistake that a lot of investors run into is mismatching the duration that they choose and the credit quality of the bond ETF that they choose with what their actual financial goals are. So help us understand how this can get people into trouble.
Yeah, so duration, I guess, by definition, is kind of a measure of sensitivity to changing interest rates. If you buy bonds that generally mature in a couple of years, your duration is shorter. If you buy bonds that might mature in 5, 6, 7 years, that's sort of mid-duration. If you buy bonds that mature in 10 or 15 or even 30 years, well, you're on the longer end of the curve. And I think there's this rule of thumb out there that is only so useful. It says, for a 1% change in interest rates, your bond will increase or decrease in value by its duration. So 1% drop in rates, 5-year duration bond goes up 5%, this kind of thing. The problem with that approach, though, is twofold, right? One is the yield curve doesn't necessarily shift. Sometimes it twists. And what that means, maybe you can think about it this way. An interest rate going from 10% to 9%, it's a 1% move, but that's still a very high rate of interest to a very high rate of interest. An interest rate change from 2% to 1% is, it's very low to very low, but you just cut the cost of borrowing by 50%, right? And so I think that the thing to remember here for investors is your duration, that sensitivity to rates. You don't want to go too far down any one path. You don't want to make your entire portfolio geared towards increasing interest rates or falling interest rates because predicting the future is kind of hard. You might get that wrong, but B, everything in moderation. You've got to prepare portfolios and accounts for multiple outcomes. I think what's interesting today is that we've had a number of cuts at the Bank of Canada. The Fed in the United States is starting to cut interest rates. But I would say that the Bank of Canada was first to raise rates when inflation sort of came back. We were first to pause rates. We were first to cut. And now the whisper into 2026 is that we may get an interest rate hike at the back half of 2026 here in Canada. Now, again, that's kind of predicting the future. You never know, but you don't want to make your entire portfolio geared to one duration or the other necessarily.
Mm-hmm. And there's different types of bond ETFs that are obviously catering to different types of sensitivities along that interest rate curve. You have a tool that I find fantastic. I'm a visual learner, so I really appreciate it. It's called the bond triangle. It can kind of help people figure out, the credit quality, the duration conversation. We have it on screen here. Can you kind of just talk us through what we're seeing here and how this could help somebody with the duration question, with the credit quality question, depending on what they're after in their portfolio?
Sure. So I'm a big fan of a guy named Carl Richards. He writes occasionally in the New York Times, and he does these napkin sketches for financial advice. And he's managed to distill complicated ideas into something really quite simple. The bond triangle isn't his, it's not his invention necessarily, but it's kind of the same thing. You could draw it on an envelope or a napkin and it could make a ton of sense. And I think the acronym here is kind of styro, think styrofoam. ST is the stability point on the triangle, yield is the Y, and RO is risk offset. Now, the thing about fixed income with bonds is each kind of bond ETF, each kind of bond fund might map closer to one of the points of that triangle than the other. I think the key to remember as investors, though, is that the closer you move to any one point of that triangle, the further away you're moving from those other goals, right? So investors need to kind of define, what is it that I want to try to accomplish, or what am I trying to achieve with my bond portfolio? And if it should be that I'm going to pursue yield with abandon, it means that I'm not going to get risk offset necessarily. It means I'm not going to get stability necessarily. There are certain bond ETFs, maybe like high yield or emerging markets or specialty credit, that will give you really great yield. But those type of ETFs or those type of bond allocations actually have a positive correlation to equity markets. They move in lockstep with the stock market. So you won't get a risk offset necessarily, and you might not get stability if we were in a period of market dislocation like we had, in the springtime of earlier this year. I went to a restaurant the other day, and it's kind of the same thing but different, right? There was a sign on the side of this restaurant, and it said, you can have fast food, you can have good food, or you can have cheap food. Choose two. And I think with the bond triangle, it's like choose one and know that you're kind of foregoing the other two. If you go too far towards one point, it is at the cost. Now, again, you don't have to choose a point. You can choose a broadly diversified ETF, and you'll be some sort of a blob, maybe somewhere in the middle of that triangle as well.
Yeah, so that's a great analogy, by the way. Although, regardless of what the two of the three that you get in the restaurant, you're still going to be asked to tip 20% at least. That's just the way of the world right now. Yeah. But I know a lot of folks like something like basic, like an aggregate bond ETF, or maybe like a Canadian government bond ETF. Just give it a quick example, like where on the triangle would that kind of thing fall?
Yeah. So, I mean, not quite directly in the center of that triangle, but you'd be fairly close to it. The bond universe type of ETF is usually investment grade. So you might be 2/3 government and 1/3 corporate bonds. You're not leaning heavily towards one of those points or another. Bond universe ETFs usually have a duration in the middle, so 6 to 7 years or so. So there is sensitivity to rates, but you're not going to make double digits, or you're not going to lose double digits due to interest rate changes. And because it's investment grade, you'll get some yield, but you won't get as much yield as if you were buying something out on the edges or the margins of safety. I think about the core satellite model. You could start with something very straightforward, almost vanilla, and then on top of that, if you had objectives that weren't sort of stay near the center of that triangle, you could tilt with additional options on top.
That makes sense. Let's get to your second bond ETF investing mistake. And this one is sort of adding needless complexity to the mix when you don't necessarily have to. And this can happen when investors, frankly, just hold too many ETFs. Explain to us why that can be too much of a good thing.
Yeah. I would say everything in moderation, and this isn't an ETF challenge. I think this is just a human nature challenge. We might have too many individual stocks in our portfolios. We might have too many mutual funds in our portfolios when fewer will do. I think, the textbook definition says, 5 to 8 exposures, 3 to 7 exposures. You're probably fairly well suited that way. More isn't necessarily better, especially if I think about, the mechanics of rebalancing. If I had a portfolio with one stock ETF and one bond ETF, well, rebalancing is fairly easy. I sell one and I buy the other every period, every year, or every half, or every quarter, or something like that. But if I've got 10 different bond ETFs, I need a spreadsheet. Pretty soon I'm dealing with smaller and smaller amounts. And if I'm paying commissions on those ETF trades like I would individual stock trades, that can add up. I think the good news is, obviously, here at TD Direct Investing, recently you've also announced 100 ETFs on your platform are now commission-free, which would make that a little bit easier for sure.
Yeah, it certainly takes some of the sting out of rebalancing. Again, it's one of the things that we often sort of grumble about, but we do begrudgingly, but at least it's a little bit more comfortable, I guess, if you want to put it that way. So yeah, that's a great call out. Another bond ETF, this is the third one on your list, the bond ETF investing mistake, is choosing a passive ETF when an actively managed one might be better. And of course, the opposite applies too, and we'll get to that. Before we kind of dig into how that can hurt investors, just help us understand again the difference between like a passive bond ETF and an active bond ETF. What is that difference?
Yeah, generally a passive bond ETF is going to buy most all bonds in a given category. There's a couple of rules around the edges. It has to be relatively liquid. It has to be available. Generally speaking, it has to be investment grade unless it's a particular kind of ETF. But you're buying the category, and what's working for you is diversification and very low costs. When you buy an active ETF, generally what you're doing is you're employing a team of analysts, a portfolio manager, to try to outperform their passive benchmark. And there's several different ways in which they're going to try to accomplish that, but generally speaking, what they're going to try to do is do credit research. They're going to analyze those fixed income opportunities, and they're going to try to avoid the ones that they feel are weaker or less fundamentally sound, and they're going to try to buy more of or invest more towards those names or those interesting opportunities as they find them.
Okay, so that's the difference between the two different types. How could going passive instead of active potentially hurt investors in some areas?
Yeah, so The beauty about active management is it works most often in inefficient markets, right? In markets where there might not be widely available information. In markets, maybe you could think about it as where if you did your homework, you might have some edge versus very efficient markets like US large cap, for example. On the equity side, it's very difficult to beat benchmarks there. But if I think about, say, high yield bonds or emerging markets bonds, if you're able to do that kind of boots on the ground research, that's where you might be able to develop some edge and actually add some value. I think what's interesting about our active management capabilities at TD Asset Management, for example, is we do our own credit research. So we would meet with companies, we would run their numbers, we would analyze their financials and their balance sheets and their financial stability, but we would make our own independent judgment to the ratings agencies. So there are these rating agencies on the street, they analyze bonds, and I think investors may have seen, well, this bond is a AA bond, but this one is merely BBB, or that one's CC or something like that. We do our own research. We don't just settle with what it is that the ratings agencies tell us. And I think what's interesting to us is over 30%, not quite a third, but about a third of the time, our own ratings do not agree with that of the street. So if we feel that a bond is actually higher quality than the street, for example, then we might be able to pick up the incremental return associated with that bond, even though our calculation says it's safer than what the street might otherwise deem. So inefficient markets is an area where active management can add some value for sure.
And you mentioned a couple. What are some other ones that might be inefficient like that where active could make sense?
If you have unrated debt, if you have mortgage type debt, again, the specialty credit, the things that are unrated, asset-backed commercial paper, things like this. Certainly different durations, different credit qualities. It doesn't only mean the stuff that's below investment grade. You can still deliver value in active management, even in higher quality securities, but generally it's going to be about that information gap. Mm-hmm. If it's widely available information and anybody and their brother can do that analysis, well, it becomes that much harder to add some value. But if there's not that complete information, if doing your homework has an opportunity to add value, that's where active management can make some sense for sure.
Okay, so what's the flip side then of that? Like, when does it maybe make more sense to go passive instead of active?
Yeah, so the flip side is just mirror image to that, right? If there's an area of the bond market where it's difficult to add value through security selection, you might be nudged towards buying something passive. So I think the quintessential example to something like that would be government bonds, right? It's not necessarily the case that an Ontario bond and a Newfoundland bond and an Alberta bond will behave the same. But they will move more closely to one another than if I'm thinking about a bond from a telco versus an energy company versus a bank, for example. Mm-hmm. And so government bonds, again, back to the bond triangle, if you're trying to get risk offset, you're trying to offset equity risk, government bonds could be a remedy for that. If I think back to dislocation, whether it's as recent as the onset of COVID, in 2020, the financial crisis back in 2008, there are times when government bonds do really, really well because they either hang in there when everything is falling off, or they actually do better than zero because investors in a flight to safety sort of bid those type of assets up. Mm-hmm. So in the case of something that's efficient or more uniform, less of a breadth of different return potentials, passive investing could make sense. And there, the side benefits really is you're going to be very well diversified, but you could also save on costs. So be careful where you spend your fee budget or your risk budget. I would say personally, active management on the corporate side makes a ton of sense, and passive on the government could be an option for investors as well.
That's a great rule of thumb to consider, because I feel like a lot of investors tend to lump themselves into like one side or the other side of this debate, and it's not an either or necessarily. It can be an and, passive Indeed. And active. So that's a good point. Let's get to your fourth bond ETF investing mistake, and this one you alluded to it a little bit earlier, is chasing yield. Mm-hmm. Yield is juicy, Trevor. Everybody wants yield. Everybody wants return. How can this backfire though? Yeah. Too much anything will kill you. I mean, or everything in moderation maybe is the smoother, kinder, gentler version of that, right? I say this, look, there's a number of different
ETFs out there that promise enhanced yield on the equity side, for example. And in the bond side, there are some bond ETFs that might yield 6% instead of 3% or something like that. And I think generally speaking, it's very difficult for investors to gauge what is a 2% difference, what is a 3% difference in the long run to investment returns. And I would want to try to reframe that almost. If my banker called me up and said, Trevor, you've been such great customers of the bank, I'd like to offer you a 2% discount on your mortgage, I would jump at that opportunity because somehow on the credit side, we all realize how valuable that is, right? Shoot, I would jump for a 1% reduction in my mortgage rate. And yet somehow, I think we kind of lose sight of a 1% improvement in returns or a 1% cost reduction. Those kind of percentages, it's the same thing. It compounds beautifully over time. But somehow we kind of lose sight of that. And I think in the context of chasing yield, to go from something that yields 3% to something that yields 6 or something that yields 9, I think investors really need to realize there's no free lunch. And so you can do that. You can pursue a much higher yield, but do be careful and maybe go in eyes wide open that if you do this, you are taking on commensurately more risk in order to accomplish that objective. This is not a free lunch. Nothing in life is free. To make more return, you do have to take more risk. I mean, we know this. But just because you take more risk doesn't mean you're guaranteed the return. There's the rub. So be careful as you pursue additional yield. Start with something that's the base, that's pretty uniform to the market as a whole. And then if you do want to lean or you do want to tilt, again, make small moves perhaps. Consider diversifying and tilting as opposed to pushing all in on one corner of the market or another.
It kind of speaks to, again, maybe some investors losing sight of what the fixed income part of their portfolio is really about. And it's that capital preservation, it's that tempering volatility. If you go really high yield bond ETFs as an example, it's almost like you're sort of adding a quasi-equity component to your portfolio, right? Like it kind of throws things off kilter, even though on paper this is fixed income, it's a different flavor of fixed income. So I'm wondering, is there a rule of thumb that you have that can help people understand, when is high yield maybe too much yield? Like is in relation to something that's more traditionally stable? I guess.
Yeah. Somebody said once, and I don't know who this is, keep your fixed income fixed. And there is variability the more you move out on the spectrum, I guess, of investment opportunities in the bond space. Again, also true of equities, right? I don't know if there's a single rule of thumb, but I would say if the basic yield of the stock market is 3%, and you are pursuing a dividend yield strategy of 6%, that is a wager that you're taking risk on. And I think in a similar fashion, if the yield on the bond market is perhaps a 3% coupon yield, and you're buying investments with a 6% coupon yield, just know that there's risk attached to that. It doesn't invalidate the idea, but it does mean that maybe you want to spread your risk around, you want to buy multiple investments, because again, nothing in life is free. You don't get 2 times the yield or 3 times the yield of something without there being some kind of an investment risk. You see that all over the place, and you always see that. There is a reason why bond yields are higher than GIC yields, and that's because there is some variability in fixed income. There's a reason why bond yields have higher yields than money market or T-bill type investments, because again, there's commensurately more risk. And similarly then, if you're buying high yield, know that there's risk there too. Mm-hmm. Again, it could be a really interesting opportunity depending on your needs as an investor to put into a portfolio. You may want to think about an active solution, and you may want to think about allocating some portion of your fixed income to that space as opposed to most of it or all of it, for example. Mm-hmm. Otherwise, you could end up with a positive correlation to the stock market. And like we saw, I guess, a few years ago in 22, stock market down, bonds down at the same time. I don't get that zig and zag or that yin and yang kind of offset in my portfolio.
Yeah, that was a rough year for a lot of investors. Seemingly nothing worked, and that's not a good place to be in. Let's get to your 5th and final bond ETF investing mistake that we'll cover here. And that one is maybe not being so mindful of pricing and trading on the bid-ask spread, particularly around market volatility. How can this burn investors? What can they do about it?
Yeah, so There is a spread between the bid and the ask on a bond ETF. Just the same as there are on bonds, just the same as there are on equities. And investors bear that cost because you are buying at the ask, you're buying at the offer, and if you turned around right away and you sold, you'd be selling at the bid. So the difference between the bid and the ask, or the bid and the offer, is in fact borne by the investor. So as such, a tighter spread is better because it means that as an investor, the frictional or the transactional costs are going to be that much lower. That said, there are a couple examples for when spreads on bond ETFs may widen. And it's not necessarily anyone's fault, it's just kind of a condition of market. So a couple quick hits. Friday, July 4th, 2025 was like any other Friday here in Canada, but yet to Americans it was the 4th of July. So the US bond market was closed, but the Canadian stock market, and therefore Canadian ETFs, and therefore Canadian ETFs with exposure to US bonds, continued to trade. Now, if you don't have visibility into the underlying, think American Thanksgiving, I guess, more recently, you can still trade in that ETF, but the bid-ask spread will be wider as a consequence to that underlying market being closed. Another one would be the bond market really tries to get to sort of wait and see attitude maybe around rate decisions. So when the Bank of Canada has a rate decision to either raise rates, to lower rates, or to keep rates steady, that is a day usually where the bond market again is wait and see, and the spreads sometimes have a tendency to widen. So if you're a long-term strategic investor, if you're buying for years, if not decades, maybe the spread cost, you can amortize that over a long period. But what is long run anymore, right? And I think even if you were an investor in the long run or not, you want to try to make sure that spread is reasonable. Measure it on a dollar basis in terms of how many pennies between the bid ask, but also measure it in percentage terms as well, because a 10-cent spread on a $100 unit might be less of a spread than a 2-cent spread on a $10 unit. Do the math on that, but take my word for it, I guess.
Don't ask me to do the math, Trevor. I don't want to do that. But yes, point taken, that you need to be cognizant of that. Is that an issue where maybe you hold off on a trade until, in the examples that you gave, like those U.S. markets reopen or something like that? Is it worth putting off a decision to trade in some cases, or wait for the volatility factor to go away?
It might. It really might. I mean, it depends on how wide that spread gets, I suppose, right? But what I would say is that Rome wasn't built in a day. And so, 1 day longer on the bond markets generally will not make too much of a difference in its overall return or your overall return as an investor in the grand scheme of things. I wouldn't say the same necessarily on the stock market side, because you can have 2% days, 3% days, but generally speaking, the bond market doesn't move to that degree. And so, if the quote doesn't look good, either you want to go in with a limit order, or you might want to necessarily wait until normal conditions kind of return and that bid-ask spread is tighter, for sure.
All right, fantastic stuff, Trevor. Lots of fantastic insights there to help investors better navigate the sometimes obscure or difficult to wrap your head around bond market, and specifically bond ETFs. Appreciate that. We got a lot more to get to, including our live Q&A, so make sure to tune in for that. But I have a question for our viewers. Are you enjoying the show so far? Did you find this educational? I certainly hope so. If you did, make sure you follow TD Direct Investing on YouTube, Instagram, and Facebook. We got sneak peek at upcoming episodes for our live content, as well as a ton of other interesting videos and static posts to level up your investing knowledge and get you to a place where you can hopefully avoid some of these mistakes like we're talking about today. So make sure to check us out. You got QR codes on the screen that you can scan. Now, Trevor, we are going to get to our Q&A in just a moment, but I want to bring in my colleague, Caitlin Cormier, because Caitlin is going to show us the ropes on how to put some of the things that you've talked about in practice on the Webroker platform, which is incredibly valuable to a lot of viewers. So let's make sure we get into that. Caitlin, welcome to the show. It's great to have you as always. Last show of 2025. Here we are. Appreciate you can join us for it.
Yeah, happy to, especially the topic. I love bonds. As you know, Rob, bonds are a very passionate passion of mine. So very excited to be able to go through this demo with you today.
Tell us, how can investors screen for bond ETFs to consider in Webroker? Show us how it's done.
Yeah, absolutely. So let's hop right in, actually. So we're going to look under the research tab within WebBroker to start. We're just going to go ahead and click on research. We're going to go under the tools there, and we're going to come down to screeners. So once we get there, we're going to have the choice to click through all these different options. We're going to select, of course, the ETF tab. And then once we're here, we're just going to click Create Custom Screen towards the right-hand side of the screen there. Once we're there, we are kind of posed with some different criteria to choose in order to pick our ETF. So I'm going to start with fund category, and that is going to allow me to choose something specific to fixed income. Now, for the purposes of today, I'm going to scroll down here, and I'm going to do, I think Canada. So when it says Canada and US on the side there, just to confirm that means where the ETF is. So like whether the company is a US or a Canadian company. So I'm going to actually do a global, let's do a global fixed income in Canada. I'm going to deselect to include mutual funds. I want to look just at fixed income. Now, for other criteria, it's completely up to you. But one of the things that we did talk about today was index or managed ETF. So you have the choice to switch between two. For the purposes of this demo, let's just show index funds only. So we can see here we're down to 34 matches, which seems reasonable for me to take a peek. So I'm going to click View 34 matches. Now, once I get here, I'm going to see a listing of ETFs done alphabetically. I can kind of scroll through here, but there's not a lot of info right on this main screen, just the stuff I've selected. So if I click on summary, I'm going to get some more detail on kind of the price, if there's a Morningstar rating. I can arrange this data. So if MER is really important to me, I can rearrange based on that. I can see performance. So lots of different stuff I can see. And of course, as always, we can do the comparison. So I can select up to 5 ETFs. Click the compare button, and it'll bring me over here to give that side-by-side comparison. And as I always say, make sure that you are comparing the apples to apples here. So if you're comparing 3 different funds, make sure that they're all based on a similar index before you start comparing them to one another.
Yeah, that's a really great point. We want to make sure that we're making fair comparisons here. So we've screened for these bond ETFs. We've narrowed the list down. Maybe we found a couple that we're interested in. What could an investor do then to help get the best price for the bond ETF that they've selected?
Yeah, and another thing that was mentioned is limit orders, right? So when we're going through the order process, if we really want control over how much we're going to pay for this ETF, then a limit order is really important, especially with that bid-ask spread if it is wider, like Trevor was saying. So let's hop into the platform and go through a ticket. So I'm just going to choose the ETF I have here, the first one. I'm just going to click buy, and it's going to bring up my ETF order ticket. Now, as I go through here, of course, my action is going to be buy. The first thing I'm going to do is switch over to limit to indicate that's how I want to proceed with my order. And I can come over on the right-hand side. I can see my high-low for the day. I can see my bid-ask spread, about 4 cents in the difference here. And then I can make a decision as to what price I'm comfortable paying for this particular ETF. Let's just say I wanted to go down a tiny bit before I commit to it. So I'm going to choose a couple cents lower than the current ask price. Then I just input here whether I want to invest a certain dollar amount or a certain number of shares. Let's just say I want 50 shares and my good till. Now, when I'm using limit orders, I may want to consider leaving it open for more than just today in case the price doesn't drop down within today's trading. But this is a quick and easy way that you can go ahead and fill that order. And if it is one of those new 100 commission-free ETFs within TD Direct Investing, it'll actually show you on, when you click that preview order, it'll actually pop up and show you, it'll reflect the 0 commission there. So exciting news.
Yeah, it's a fantastic development. Great call out as well. Caitlin, appreciate that. And like I said, last episode of 2025, so happy holidays to you. We'll see you in the new year. We look forward to it. And all the best over the holidays, yeah.
Same to you and your family.
Appreciate it. That's Caitlin Cormier. She's our Senior Client Education Instructor at TD Direct Investing. All right, Trevor, the time is upon us. It's time to open the floor, take some questions from our viewers. You ready to get at it?
Ready.
All right, let's fire up our first question here. We have one coming to us from Iting, I believe. For passive bond ETFs, I can't manage allocation yield or duration, and I've seen little price return this past year. Are there long-term benefits to holding them? Trevor, what do you think?
There are benefits. There are benefits. Look, I mean, there are periods in any investment's life where things kind of tend to go sideways. And I think depending on your time horizon, if you looked at these bond universe ETFs, look, they do not have a very attractive 5-year return, for example. A lot of that was because of 2022 in particular, when inflation spiked and interest rates rose around the world to try to fight that down and to tamper that inflation. Returns on these bond universe ETFs were unfortunately low and negative in some cases. That said, I think it's a really interesting place to park your dry powder, if you will. You know, when the stock market goes on sale, as it inevitably does once, several times every year, having something available to you to rebalance out of and into equities is a useful idea. Again, in the short run, it's been an interesting as the saying goes, an interesting adventure. But in the long run, generally bonds do outperform cash. You could say, well, cash could be my dry powder, but bonds over the long run do outperform cash or cash-like instruments. So you may want to have one or both of those available to you in that case.
Yeah, and I mean the nice thing with like a bond ETF as opposed to cash is you get the chance to earn some return, but also ETFs make it very easy to get in and out of the trade, right? So you can get that dry powder on hand very quickly.
Indeed.
Okay, great points there. Let's get to our next question. Locke has a question. The MER, or management expense ratio, on an actively managed ETF is generally higher than a passive ETF. Yes, that's generally correct. What are your views on MERs, and what do you consider reasonable?
Ooh.
Yeah, it's a tricky question.
Yeah, I mean, I think everybody's a little bit different. What you can think of maybe is to subtract the two. So if there was a passive MER of 0.1 and there was an active MER of 0.6, for example, and those wouldn't necessarily be, unreasonable or atypical, that delta, that difference is 0.5%. And really what that means is, okay, what do I gauge this manager and her team or his team, are they going to be able to deliver that additional 0.5% of return through active selection, through managing the curve, through managing duration and so on. And again, pulling all those different levers that you have with fixed income that are different levers than you would have with equities, for example. And so if it was the case that one of them had a fee or an MER of 1.1 and one of them had an MER of 0. Well, you're starting to get that fee differential is starting to grow a little bit. And again, 1% in the long run is huge, right? As I said earlier. But generally speaking, with bond ETFs, you don't get that high a delta. It is possible to buy bond ETFs with MERs approaching 1%. I don't know if there's any above 1%. But again, if you're going to pay that, just make sure there's value for money or value for fees at the end of the day. And performance is always reported net of fees. So the beauty is, regardless of that fee, you can look at what the outcome actually was as you evaluate these different ETFs for your portfolios, for sure.
Yeah, and you had mentioned some markets too earlier that lend themselves, generally speaking, to active versus passive, so that's something to consider as well. Let's get to our next question. This one from Mike. Mike wants to know, I'm working on a low-risk portfolio. Can you build a portfolio using only bond ETFs? So zero equity, 100% bond. What do you think about that idea, Trevor?
You could. I mean, this might be low risk as defined by the standard deviation of your portfolio. So in other words, you might not get a lot of variability of returns if you built a portfolio that was 100% bonds. There's a slightly different risk, I think, to introduce that we didn't really cover, and that is inflation risk, or preserving the purchasing power of your portfolio. So if you're able to earn a yield to maturity above that of inflation, well, you're going to preserve the purchasing power of that portfolio. Unfortunately for all of us, inflation is a moving target. And thank goodness, knock on wood, it's actually gotten lower, and hopefully we've wrested control of things, and we're off to the races as far as tampering and keeping down inflation. But that would be one of the risks instead. Again, thinking of that bond triangle, sort of the stability point of that triangle would also minimize your price return, and maybe, hopefully, if prices don't move much, your return would just be the coupon that you're earning on the bond, this kind of thing. That's certainly possible with bond ETFs. You'd probably be looking at sort of universe or shorter duration bond ETFs, maybe the bond ladders, maybe the target maturity bond ETFs, which actually terminate every year. You've got a number of choices to think about, but yeah, you could do that with bond ETFs. The beauty of the bond ETF market, even in Canada, with $700 odd billion worth in total, is that we've got all kinds. We have active, we have passive, we have long duration and short. We have government all the way to high yield. There's emerging markets. Like anything you want in the bond market, it's very likely, it might not be certainty, but it's very likely that you can get that exposure via a reasonably costed exchange traded fund.
Now, of course, we don't know too many details about Mike and Mike's specific financial goals and needs and stuff like that, but 0, 100 or 100% bond portfolio, that seems quite extreme at face value. That sounds really atypical. I don't know, Trevor, what do you think about the idea of going like that extreme, I guess, if you're looking to mostly preserve capital? Like, is that swinging too far in the one direction?
I mean, maybe. You're right. We don't know his tolerance for risk, his time horizon, his specific investment objectives. That is, I don't want to use the word bet or wager, but that is a lot of faith in that one asset class being able to deliver what his investment objectives are, right? And so in a similar fashion, a 100% equity portfolio, could it work? Yeah, maybe, if you had the right temperance and risk tolerance and you weren't going to panic like I sometimes do in my own accounts and things like this. So if you have the right temperance, you could definitely do that. It would have to be for a specific set of investment needs. And hey, everybody's different, right? So I can't sit here and say it's a bad idea or it's a good idea without knowing Mike a lot more. But it is something that could deliver on his investment objectives for sure.
Mm-hmm. Okay, so food for thought, Mike. Keep that in mind. Let's get to our next question. This one coming to us from Jenny. Jenny wants to know what allocation percentages to short, mid, and long-term bond ETFs are recommended in the current economic environment. Now, again, we can only say so much about asset allocation without knowing more about you specifically, Jenny, but in general, what do you think, Trevor? Is there, like a rough guideline or something or a jumping off point?
Yeah. I mean, I don't know that there's a specific ratio that people should adopt or that people should adhere to. I think the more long duration you put in a portfolio, the more you're moving to the risk offset point of that triangle. So if it was your presumption that 2026 was going to be poor for stocks or the economy at large, I might want more long duration bonds as a risk offset, for example. If I wasn't sure, well, the universe is a great starting point. I think of the core satellite model. You start with a bond universe, ETF of some sort, and there's a bunch of them to choose from, and they're all very low cost. And then depending on your views, you could sort to tilt things. When I think of, say, shorter duration credit bond ETFs, for example, those typically offer you the stability point of that triangle, right? And that kind of 2 to 3 year duration investment grade bond ETF, those are never going to be hero and they're never going to be zero to your portfolio. They're kind of singles and doubles, if you will, to use a kind of a baseball analogy. So not the home run king or queen, not the strikeout, winner of the year, or most strike, but a consistency sort of approach. And so again, investment objectives are very, very different. So I'd be hesitant to assign percentages to those, but those objectives, maybe as painted, might help her inform what it is that she might ultimately want to allocate to and in what degree.
Mm-hmm. Trevor, I'd be lying if I said your baseball analogy didn't hit me right in the feels with the Blue Jays getting so close and not quite getting it done. But it's an easy one to understand, and we always got next season too. Yeah. Okay, we got time for one more question. This one from Dennis. Dennis says, for bond ETF holders, what are the key tax considerations? Are distributions interest income?
They are. So, in most all cases for exchange traded funds, there is no alchemy, if you will, right? So if my ETF is full of bonds, the income that I earn from that ETF will be interest, just the same as if I was holding the individual bonds. If my ETF is full of Canadian dividend-paying stocks, then the income I receive from that ETF will very likely be eligible dividends per the sort of the Canadian sort of tax system. If my investment is in a US equity ETF, then any income I receive from that will be taxed as foreign income, generally speaking. Just the same as if I bought American stocks myself and I got some dividends from, US securities or something like that. Now, exceptions to every rule. There are some corporate classes. There are some things that try to do a little bit more or less than that. But for all intents and purposes, the tax characteristic of an ETF is going to mirror that of its underlying asset class. So, you can think then as an investor, or Mike can think as an investor about asset location. Do I want to put my bond ETFs inside of a tax-sheltered plan like an RSP or a RIF or a TFSA? And do I want to put equity ETFs in a non-registered or taxable account or something like that? It's going down the rabbit hole a little bit, but I would say generally back to the question, whatever the asset class generally pays from a tax perspective, the ETF is going to do the same thing.
Okay, so that's a good rule of thumb to know. Of course, always read the fine print of the fund facts, of course, right? Like, you always want to know what you're getting into.
Yes.
Okay, thanks for that question, Dennis. And thank you to everybody who wrote in. Dennis, that's right. Thank you for everybody who wrote into your questions. Fantastic stuff. Trevor, we appreciate you fielding all of these great questions and giving your tips to us. Pleasure to have you in studio. We'll have to have you back again real soon.
Thanks, Rob. Thank you very much.
And for our viewers, of course, programming note, like I teased there earlier, last show of 2025 was today, but we're back in 2026, and we got a fantastic episode coming up that you don't want to miss. In January 8th, Thursday, January 8th, we have Dan Kent from Stock Trades coming in. He is going to share his top investing tips for the TFSA, the RRSP, and the FHSA. I'm going to pat myself on the back for getting through all those acronyms without flubbing it. He's going to tell us how to take advantage of the new contribution room you get for some of those accounts, and just some of the top tips that can help you prosper in the new year. That's all the time we have for this edition of the show. From everyone at Inside Investing, we appreciate you tuning in for 2025. Look forward to seeing you in 2026. We'll see you then. Take care.
Have more questions? Check out the links to the right and in the description below.